Smith & Wesson survived the Civil War, 2 world wars, the Great Depression, every economic crash, political shift, and cultural change America threw at it for 170 years. But in a single trading session in June 2025, the stock collapsed 19%. Sales were down 12%. The CEO had no good news for investors. And today, the share price sits 47% below its peak with no recovery in sight. A brand that outlasted everything is now struggling to outlast its own decline. What changed? The answer is more complicated than anyone in the industry wants to admit. Smith & Wesson was born in 1852 when Horace Smith and Daniel Wesson partnered to create what they called a repeating pistol. Their first factory in Norwich, Connecticut, produced weapons that could fire multiple rounds without reloading, a revolutionary concept that would define American gunmaking for generations. The company's breakthrough came with the Model No. 1 revolver in 1857. This small, reliable pistol became the weapon of choice for Union soldiers during the Civil War, establishing Smith & Wesson as a serious competitor to established manufacturers like Colt. The distinctive breaktop design allowed shooters to quickly eject spent cartridges and reload, giving Union forces a significant advantage in battle. After the war, Smith & Wesson's reputation spread westward with the expanding frontier. The famous Model 3 revolver, known as the American, became the sidearm of choice for lawmen like Wyatt Earp and Wild Bill Hickok. The company's weapons were prized for their accuracy and reliability in the harsh conditions of the American West. But Smith & Wesson's real transformation came in the 20th century. The company moved from Springfield, Massachusetts to a larger facility that could handle military contracts during both world wars. The Victory Model revolver, chambered in .38 Special, became standard issue for American military police and Allied forces worldwide. By 1945, Smith & Wesson had produced over 800,000 Victory models, cementing their reputation as America's premier military contractor. The post-war boom brought new opportunities. Smith & Wesson introduced the Model 29 Magnum revolver in 1955, the most powerful handgun ever created at the time. When Clint Eastwood wielded the massive revolver in Dirty Harry, calling it the most powerful handgun in the world, Smith & Wesson achieved something money can't buy: cultural immortality. Throughout the 1970s and 80s, the company dominated law enforcement markets with revolvers that officers trusted with their lives. Police departments from New York to Los Angeles standardized on Smith & Wesson firearms, and the company's training programs became the gold standard for professional shooting instruction. The 1990s brought challenges and adaptation. As criminals began carrying semi-automatic pistols with higher capacity magazines, law enforcement demanded similar firepower. Smith & Wesson responded with the Sigma series pistols and later the military and police line, proving they could compete with Glock and other polymer-framed manufacturers. When the assault weapons ban expired in 2004, Smith & Wesson was perfectly positioned to capitalize on the civilian market's renewed interest in tactical-style firearms. The M&P15 rifle and sports series became bestsellers among recreational shooters and competitive marksmen. The company traded publicly under various structures through the 2000s, eventually adopting the NASDAQ symbol SWBI in June 2020. Throughout this era, Smith & Wesson's stock price reflected the cyclical nature of the firearms industry, rising during Democratic administrations when gun control fears drove sales, and declining under Republican leadership when those fears subsided. Barack Obama's presidency marked Smith & Wesson's golden era. From 2009 to 2016, fears of expanded background checks, assault weapon bans, and other restrictions drove unprecedented civilian demand. Smith & Wesson's stock price soared from under $3 to over $30 per share. The company expanded production capacity, hired hundreds of workers, and introduced dozens of new models to meet surging demand. The Sandy Hook shooting in 2012 triggered the largest gun-buying surge in American history. Smith & Wesson's factories ran 24 hours a day, 7 days a week, but still couldn't keep up with orders. Dealers nationwide reported months-long waiting lists for popular models like the M&P Shield concealed carry pistol. By 2016, Smith & Wesson had become one of the most profitable companies in America relative to its size. Annual revenues exceeded $700 million, and profit margins reached levels that made investors euphoric. The company seemed to have cracked the code of American gun culture, creating products that satisfied both tactical professionals and recreational enthusiasts. But the 2016 election of Donald Trump marked the beginning of Smith & Wesson's current crisis. When Trump won, fears of gun control evaporated overnight. The phenomenon known as the Trump slump hit the entire firearms industry as panic buying ceased and inventories swelled. Smith & Wesson's stock price began a steady decline that would continue for years. By 2017, the company was laying off workers and cutting production as dealers struggled with excess inventory. The boom-bust cycle that had driven firearms sales for decades was entering its most severe downturn since the 1990s. The COVID-19 pandemic briefly reversed this trend. Widespread civil unrest, empty store shelves, and fears of societal collapse drove millions of first-time buyers into gun stores nationwide. In 2020, Americans purchased an estimated 21.8 million firearms, the highest annual total in history. Smith & Wesson's factories again ran at maximum capacity, and the company's stock price briefly recovered. But this pandemic surge proved to be the last hurrah for traditional gun sales patterns. By 2021, the market was flooded with inventory from the pandemic buying spree. New gun owners who had purchased firearms during the crisis were not becoming repeat customers at the rates the industry expected. Worse yet, the fundamental economics of gun ownership were changing. Unlike cars or electronics that wear out and require replacement, quality firearms can last generations with minimal maintenance. The market was approaching saturation, with an estimated 390 million civilian-owned firearms already in circulation across America. Smith & Wesson began reporting disappointing earnings as early as 2022. Sales volumes declined, while production costs rose due to inflation and supply chain disruptions. The company's margins compressed as they were forced to offer discounts and rebates to move inventory that was sitting in warehouses across the country. The 2024 presidential election failed to provide the traditional Democratic bump that gun manufacturers had relied on for decades. Even though Joe Biden won, gun sales continued declining as consumers prioritized other spending in an inflationary environment. Smith & Wesson's management team began warning investors that the cyclical patterns they had counted on might be permanently broken. By September 2024, the scope of Smith & Wesson's problems became undeniable. The company's first quarter fiscal 2025 results showed net sales of just $88.3 million, representing a staggering 22.7% decline from the previous year. CEO Mark Smith admitted during the earnings call that demand was softer than anyone anticipated. The stock market's reaction was swift and brutal. Smith & Wesson shares plunged more than 10% immediately after the earnings announcement. Investors who had bought at the peak were now looking at losses exceeding 50% as the company's market capitalization evaporated. But the bad news was just beginning. Smith & Wesson's fourth quarter results in June 2025 showed another decline, with net sales falling to $140.8 million, down 11.6% year over year. This time, the stock dropped 19% in a single trading session as investors lost confidence in management's ability to navigate the downturn. The company's annual report, released in August 2025, painted an even grimmer picture. Gross profit had declined $30.9 million, representing a 19.6% decrease from the previous fiscal year. For a company that had generated industry-leading margins during the boom years, these numbers represented a fundamental breakdown in the business model. Perhaps most concerning was the trend in background checks, which serve as a proxy for overall industry health. The National Instant Criminal Background Check System, known as NICS, showed 7 consecutive months of declines from February through August 2025. These weren't minor dips but substantial decreases, with August showing a 9.9% year-over-year decline. July 2025 marked a particularly ominous milestone. For the first time in nearly 6 years, monthly NICS checks fell below 1 million, a threshold the industry had consistently exceeded since 2019. This suggested that the post-pandemic normalization wasn't just a temporary correction, but potentially a permanent shift in consumer behavior. Smith & Wesson's third quarter fiscal 2025 results, announced in March 2025, confirmed investors' worst fears. The company reported a widened net loss of $3.4 million, compared to a much smaller loss the previous year. Even more troubling, long gun sales had crashed 28.1%, devastating a product category that had been a growth driver during the tactical firearms boom. The company's stock price continued its relentless decline throughout 2025. Shares that had traded above $25 during the pandemic peak fell to under $10 by year-end. Investors who had believed in the long-term growth story of American gun culture were now questioning whether that story had fundamentally changed. Smith & Wesson's problems extended beyond simple demand destruction. The company faced rising costs from multiple directions, creating a margin squeeze that made profitability elusive even at reduced volumes. Steel prices had increased due to tariffs and global supply chain disruptions. Labor costs were rising as skilled manufacturing workers demanded higher wages in a tight job market. Regulatory pressures added another layer of complexity. While Smith & Wesson had successfully navigated previous political cycles, the company now faced state-level restrictions that were more targeted and persistent than federal legislation. California's assault weapon restrictions, New York's licensing requirements, and other state-specific regulations created a patchwork of compliance costs that ate into margins. The Trump administration's return to power in 2025 brought unexpected challenges. While gun manufacturers had historically benefited from Republican policies, Trump's tariff agenda threatened to increase costs on imported components and raw materials. Steel tariffs, in particular, hit gun makers hard since firearms require specialized metallurgy that often involves imported alloys. Consumer behavior patterns were also shifting in ways that hurt traditional manufacturers like Smith & Wesson. The rise of online firearms sales through platforms like Guns.com and Gunbroker.com was disrupting established distribution channels. Direct-to-consumer sales models allowed smaller manufacturers to compete more effectively, pressuring larger companies' pricing power. Perhaps most significantly, the demographic profile of gun buyers was changing. Younger consumers were more price-sensitive and less brand-loyal than previous generations. They were also more likely to purchase accessories and modifications rather than complete firearms, shifting spending toward the aftermarket rather than primary manufacturers. Smith & Wesson's first quarter fiscal 2026 results, released in September 2025, showed how these trends were accelerating. Net sales of $85.1 million represented a 3.7% decline from the already depressed levels of the previous year. The company's gross margin had fallen to 25.9%, well below the healthy margins the company had enjoyed during better times. Even more concerning was the composition of these sales. While handgun shipments had increased 35% due to new product introductions, this growth was more than offset by the collapse in long gun sales. The rifle and shotgun markets that had driven growth during the tactical boom were essentially in freefall. CEO Mark Smith's commentary during the earnings calls revealed the depth of management's concerns. He repeatedly cited macroeconomic factors, industry trends, and consumer caution as headwinds that would likely persist. The confident growth projections that had characterized previous earnings calls were replaced by cautious guidance and warnings about continued challenges. The company's balance sheet remained relatively strong, with manageable debt levels and adequate cash flow to fund operations, but investors were no longer focused on financial stability. They wanted to see a credible path back to growth, and Smith & Wesson's management team was struggling to articulate such a vision. Industry analysts began questioning whether Smith & Wesson's problems were cyclical or structural. During previous downturns, the company had maintained its competitive position and emerged stronger when demand recovered. This time felt different. The fundamentals that had driven firearms growth for decades appeared to be permanently altered. The broader firearms industry was experiencing similar pressures, suggesting that Smith & Wesson's problems weren't company-specific but rather symptomatic of larger market forces. Ruger, another major manufacturer, reported declining sales and compressed margins. Vista Outdoor, which owns several ammunition brands, announced layoffs and facility closures. Even the accessories market, which had been growing rapidly, began showing signs of saturation. Scope manufacturers and holster makers reported slower growth as consumers became more selective about discretionary purchases. The political landscape added another layer of uncertainty. While Republican control traditionally benefited gun manufacturers, Trump administration policies created new concerns. Tariffs threatened to increase costs, while deregulation reduced the panic buying that drove previous sales. Smith & Wesson's second quarter fiscal 2026 results, released in December 2025, showed that conditions were continuing to deteriorate. Net sales fell to $124.7 million, a 3.9% decline from the previous year. The typical seasonal uptick had failed to materialize. Management's guidance projected demand to be similar to fiscal 2025 levels, with continued pressure from inflation and tariff-related cost increases, essentially telling investors not to expect any meaningful recovery in the near term. The stock market's response was predictably negative. Shares continued trading near multi-year lows, wiping out billions in shareholder value. Wall Street research analysts began cutting their price targets below $15 per share, issuing hold or sell recommendations. Institutional investors began reducing their positions, while put option volume increased substantially as investors bet on further declines with a bearish bias. Smith & Wesson's management team attempted to address investor concerns by emphasizing their innovation pipeline and new product development, highlighting successful launches like the Shield Plus pistol line. However, investors were skeptical that new products could offset the broader industry decline. The company pointed to market share gains in key segments like concealed carry pistols and law enforcement contracts. Management argued this positioning would enable faster growth when market conditions improved. But investors were increasingly questioning whether market conditions would improve at all. The fundamental drivers that had powered firearm sales for decades seemed to be weakening. Urban migration and generational changes were creating a population less interested in traditional shooting sports, while the rise of virtual entertainment provided alternatives that were more accessible and less expensive. Economic pressures were also reshaping consumer priorities. With inflation affecting everything from housing to groceries, discretionary purchases like firearms were becoming harder to justify for middle-class families. The premium pricing that had sustained industry margins during boom periods was no longer sustainable in a cost-conscious environment. Smith & Wesson's international expansion efforts were facing headwinds as foreign governments implemented stricter import controls. Simultaneously, the company's acquisition strategy became cautious as management focused on preserving cash. Employee retention became an increasing challenge, and the resulting brain drain threatened to undermine competitive advantages just when innovation was most needed. Supplier relationships also came under strain, complicating inventory management. The dealer network that had been Smith & Wesson's distribution strength became a liability as retailers struggled with excess inventory and compressed margins. Online sales channels provided some offset, but traditional advertising was less effective at reaching digitally native younger consumers. Furthermore, social media marketing faced unique challenges due to platform restrictions. The legal environment added another source of uncertainty. Product liability lawsuits were becoming more frequent and aggressive, raising defense costs. Banking relationships also became more complicated as financial institutions restricted services to firearms-related businesses, increasing operational costs and limiting strategic flexibility. Smith & Wesson's third quarter fiscal 2026 earnings, released in March 2026, provided a shocking plot twist. Just when analysts had written them off, management stabilized gross margins and returned to positive earnings growth. The company reported a massive rebound, with net sales surging to $135.7 million, a 17% increase year over year. Success with new product introductions proved innovation could still drive growth despite broader industry headwinds. Supply chain optimization provided critical relief from cost pressures, protecting margins effectively. Management's capital allocation decisions suddenly looked much smarter, as the dramatic revenue recovery silenced investors who had questioned their maintained dividend payments. Looking ahead, international expansion and the broader industry's consolidation trend may create opportunities for well-positioned companies like Smith & Wesson to offset overall market decline. However, the fundamental question remains whether the American firearms market has permanently shifted to a lower growth trajectory. Demographic trends, cultural changes, and economic pressures suggest the boom cycles of previous decades may not be repeatable. Smith & Wesson's recovery will require adaptation to this new reality. The company's ability to innovate, control costs, and efficiently serve a more mature market will determine its long-term success. The next 12 to 18 months will be critical. Companies that successfully navigate this transition may emerge stronger, while those that fail to adapt risk becoming artifacts of a bygone era. Ultimately, Smith & Wesson's story proves that brand legacy alone cannot survive structural market shifts.